You see it on your chart. A picture-perfect pin bar right at a key resistance level. The textbook says it's a high probability sell. You jump in, set your stop loss just above the wick, feeling confident. And then it happens. Within minutes, the price screams right through your stop, knocking you out of the trade, only to reverse and plummet downwards exactly as you predicted, but without you. If that stings with familiarity, trust me, it's not a coincidence. Have you ever felt like the market is personally out to get you? That perfect signal wasn't just wrong, it was a lie. But it's not a lie about the market's direction. It's a lie designed to take your money before the real move even begins. In this video, I'm going to show you why these obvious signals are often liquidity traps and what you should be looking for to be on the right side of the trade. Let's get one thing straight. You're not failing because you're bad at reading charts. You're likely failing because you were taught to look for the wrong things. The world of trading education loves simplified patterns, engulfing bars, hammers, double tops, and we're told to trade them on sight. But here's the uncomfortable truth. By the time you see that perfect pattern, the smartest money has already positioned itself. The first trap is what I call the isolated candle trap. You spot a beautiful bullish pin bar on the 5-minute chart and you get excited to catch the reversal. But you've completely ignored the bigger picture. The daily and 4-hour charts are in a clear downtrend, painting a steady series of lower highs and lower lows. That small signal is just noise in the context of the larger trend. Trading against that dominant flow is a losing game. This leads us straight to the next pitfall, the overtrading trap. Because you believe every pin bar or engulfing pattern is a green light, you end up taking dozens of trades in choppy, meaningless market conditions. This doesn't just bleed your account through commissions and small losses. It destroys your psychology. You get emotionally worn out. You start second-guessing every move, and then the real danger appears. Revenge trading. You size up to win back your losses, and the market punishes you for it all over again. Many traders think identifying support and resistance is enough. They see the price hit a key level, spot a rejection candle, and enter. But in reality, these obvious levels are often where the market finds the fuel it needs to move. That rejection you saw? It was likely just a pause, a moment of inducement, before the real move. These textbook patterns, when seen in isolation, are the bait. They look perfect, they feel right, and they are consistently the reason retail traders get burned. The problem isn't the pattern itself, it's that you're missing the context that tells you whether it's a real signal or a cleverly disguised trap. So, if these signals are traps, who's setting them? And why? This is where you need a shift in perspective. The market isn't a random force, it's a battlefield for liquidity. On one side, you have retail traders. On the other, you have the smart money, the institutions, banks, and hedge funds. And they have a huge problem. They need to buy or sell massive positions without spiking the price against themselves. How do they solve this? They need a flood of orders coming into the market that they can trade against. And where does that flood of orders come from? It comes from you. It comes from your stop loss. This brings us to the most painful trap of all, the stop hunt, or more accurately, the liquidity grab. While institutions can't see your individual stop loss, they know exactly where clusters of stops are likely to be placed, right below obvious support or above obvious resistance. So, what happens is a rapid, aggressive price move, often just a long, sharp wick that pushes the price just far enough to trigger all those stops. The moment your sell stop is triggered, you are providing the sell orders they need to fill their huge buy positions at a better price. Once they've absorbed that liquidity, the price is free to reverse and move in the intended direction, leaving you on the sidelines with a loss. This is also how the FOMO entry trap works. The market makers create a huge explosive candle that breaks a key level, Retail traders, driven by the fear of missing out, see this and pile in, chasing the move. But they're getting in at the worst possible price, right when institutions are starting to unload their positions onto the swarm of emotional buyers. The breakout quickly fails, the price reverses, and everyone who chased the move is now trapped. Your losses aren't just bad luck. They are often the fuel institutions use to execute their strategies. They capitalize on predictable retail behavior, the same behavior taught in most trading books. Your predictability is their opportunity. Now that you understand the problem, what's the solution? It's simple, but it's not easy. You have to stop thinking like a retail trader and start thinking about where the liquidity, the trap, is being set. Stop trading the obvious signal. Start trading the aftermath of the trap. Here is how you can do just that. First, context is king. Before you even think about an entry on a lower time frame, you must start on the daily or 4-hour chart. Identify the overall market structure. Are we in a clear uptrend or a downtrend? Understanding the dominant market flow is the single most important filter you can have. A bullish signal in a bearish market isn't an opportunity, it's probably bait. This step alone will help you avoid the isolated candle trap. Second, hunt the hunters. Instead of placing your stop loss at the obvious spot right below a swing low, you need to think differently. Ask yourself, where would everyone else put their stop? And consider if that area is likely to be targeted. You can anticipate the stop hunt, wait for the price to spike through a key level, grab the liquidity, and then show signs of reversing. That wick that just stopped everyone out, that becomes your entry signal. You're entering precisely when the trapped traders are being forced out. Third, remember that patience pays. The FOMO that drives you to chase big green candles is your worst enemy. If you miss a breakout, let it go. Professionals wait for pullbacks. A real healthy trend will always have retracements. Let the price come to you. Wait for it to pull back to a valid area of interest, a level that holds structural importance. This is where you find high probability, low risk entries, not in the middle of a frantic chase. If you miss a move, another one is always around the corner. And finally, the unbreakable rule: manage your risk. None of this matters if one bad trade can wipe you out. Before you enter any trade, you must know your entry point, your invalidation level, and your target. Never risk more than 1 to 2% of your account on a single trade. This isn't just a suggestion, it's the bedrock of long-term survival in this business. The perfect price action signals you see are often not entry signals at all. They are signals of where liquidity is building up. They are bait. The market is a strategic game, and it preys on the predictable, emotional reactions of untrained traders. But now you have a choice. You can continue to trade the obvious patterns and get hunted with the herd, or you can start seeing the market for what it is, a strategic game of liquidity. By understanding the higher time frame context, anticipating liquidity grabs, waiting patiently for high-quality setups, and protecting your capital, you can flip the script. You can start using the traps set for others as your entry signals. The choice is yours. If this idea of trading liquidity and traps is new to you, and you want to see how to spot these setups on a live chart, make sure you subscribe and hit the notification bell. In the next video, we'll break down these concepts with real-world examples.